fully prepared for a possible period of stagflation, and don't be surprised if your stock and crypto portfolio go down even more. Hey everyone, it's your girl Rose. I am back with another video. Right now, the economy is at an inflection point. And the question is, are we going to be able to get inflation back down? Will we be able to do it without causing a recession? And how much more will stocks keep crashing? These are the questions on everybody's minds right now. And at the moment, all eyes are on the Fed. It's the Fed's job to keep the economy healthy and keep inflation under 2%. Obviously, they failed miserably because inflation is more in the range of, 8% these days. But the Fed's job really isn't easy. It's a very delicate balancing act to keep inflation in check, to keep it low, and to keep the economy growing at a nice pace. It's really hard to do both at the same time because in order to control inflation, the Fed has to raise interest rates. But raising interest rates slows down the economy. It's kind of like trying to lose weight while also eating a lot of Twinkies. It's really hard to do both at the same time. So that is the big debate right now. Will the Fed be able to lose weight and continue eating a lot of Twinkies? In other words, get inflation down and keep the economy growing. Because if not, we are in big trouble. If the Fed is not able to pull this off, we're gonna get something called stagflation, which is when you have high inflation and a stagnating economy. Just think higher food and gas prices, but less income and less jobs. It is a very bad combination. Now, for the record, stagflation is also terrible for the stock and bond markets. We're already freaking out over the 20-30% decline so far, but it might be nothing compared to what would be coming if we get stagflation. In the 1970s, for example, when there was stagflation, the stock market fell a total of 60% from the high before it started to turn around. And given Bitcoin's apparent correlation to stocks, if stagflation happens, it'll probably be bad for crypto too. Ditto for housing, which has also been in a bubble. So now what? I mean, basically, we're all screwed. Just kidding. We're gonna be okay, so let's all take a deep breath together. This video will help you figure out your game plan if you're either brand new to investing and want to get in now, or you're already invested and just want to make sure you have your bases covered. I'll talk about the two most likely scenarios that we'll see over the next year or two, according to experts such as Ray Dalio, Cathie Wood, and Warren Buffett, and I'll end with my best advice on how to invest right now. But before we get into that, let's start with a quick recap of everything that's happened so far. The S&P 500 is down almost 20% on the year, and the Nasdaq is down 29%. That's already pretty bad, but the picture is even worse for certain growth tech stocks. ARKK, which is Cathie Wood's innovation ETF, is down 70% from the peak. As for crypto, Bitcoin is down more than 35% year to date, Ether is down almost 50%, and yeah, needless to say, everybody's portfolios are getting crushed right now. As for inflation, you're probably noticing it already in your day-to-day. Food prices are almost 10% higher than a year ago, energy prices 30% higher, and if you drive, you're now paying 1.5 times more than last year on average. So why is all this happening? Now, it's been well known for a long time that all the fiscal and monetary stimulus, as well as the supply chain disruptions from COVID, would probably cause inflation. So we were kind of expecting this. And so when the Fed started talking about higher interest rates to help curb inflation, the market reacted badly because the market doesn't like higher interest rates. This is logical because stock prices would no longer be benefiting from easy money, low interest rates, stimulus checks, and all that excess cash pouring into the stock market. I actually talked about this in my 2022 market outlook video, which you can check out right here. Now, despite stock prices suffering a bit this year, the general consensus overall was that as long as the Fed kept raising rates at a good pace, we'd probably get back on track with inflation and the economy would continue to grow and all this would just be a blip on the radar. And then Russia invaded Ukraine. I honestly can't believe the world that we are in right now. So many innocent people are dying because of some megalomaniac in Russia, and the repercussions go way beyond the borders of Russia and Ukraine, actually. Because Russia produces 10% of the world's oil, and Russia and Ukraine together are basically like the world's breadbasket. Together, they export more than a quarter of the world's wheat. The countries are also key suppliers of many other important commodities like corn, barley, and even metals used to produce cars and semiconductors. So given this huge external shock factor, inflation went from being a code yellow issue to being a code red issue. Now it's no longer just an easy fix of raise rates little by little so that inflation will go away. Now the Fed is stuck between a rock and a hard place because in order to stop inflation, we need aggressively higher interest rates, like aggressive. And that could actually cause a recession, or what the media likes to call a hard landing. At the same time, not being aggressive about raising rates would mean inflation could spiral out of control. So it's really hard to control inflation and not cause a recession. Like I mentioned before, it's like trying to lose weight while also eating a lot of Twinkies. Very hard to do both. In terms of how this is going to play out over the next year or two, it all depends on how it goes with inflation. Everything hinges on inflation. In a report by Ray Dalio's people at Bridgewater, the largest hedge fund in the world, they pointed out that in the past, high inflation almost always required a recession before inflation normalized. That's unfortunate because it means that we probably won't be able to avoid a recession if inflation keeps getting worse. The report also said that the possibility of recession isn't priced into the market yet. So the blue line is where the S&P 500 is, or how it's done recently, and the red line shows where the S&P 500 would be if interest rates hadn't gone up recently. Basically, this chart is telling us that the recent stock market crash was only due to higher interest rates, the Fed raising rates. But if a recession actually hits, the stock market hasn't priced that in yet, so it has much further down to go. So let's hope that inflation goes away on its own without a recession. All right, so that is kind of the bad news, but there's also some good news. Not everyone is as pessimistic about the future. Cathie Wood, the fund manager of ARK Invest, she believes that inflation is gonna go away on its own later this year, that it's temporary, and that it's not gonna be as bad as everyone is expecting. To back up her view, she points out that just in April of 2020, Target's inventory levels went up by 42%, Walmart's by 33%, and Home Depot by 32%. And these companies even had to cut prices to clear the shelves. That's really interesting because that does not sound like inflation to me. That sounds like deflation. And this is at 3 huge, well-managed companies. I really hope she's right, but obviously it's too early to tell. We'll only know after we see a couple of more monthly inflation data releases. The next one is on June 10th. That's definitely something that all investors will be watching out for. And you can actually track the inflation data yourself directly from the source on the Bureau of Labor Statistics website. I'll link to it below. So I know all this uncertainty makes it really hard to make decisions. We're at the cusp of 2 very diverging possibilities, and it's too early to tell which one is gonna happen. Back in my early 20s, I remember reading all these articles about how the US dollar was gonna collapse and that gold was the place to invest in. And I was so convinced that the dollar collapse was imminent and that I was 100% right and I was gonna make a ton of money. Well, the dollar collapse never happened and my gold investment did absolutely nothing for 3 years. Meanwhile, I missed out on all the stock market gains, which in that time was a lot. What I learned from that experience is that nothing is a sure bet. As much as everyone is talking about inflation, it might go away. We just don't know yet. And we might not get into recession. So in life and in investing, you have to make decisions knowing that nothing is a sure bet. That's why I always go back to this quadrant. There are 4 economic environments. There's periods of high inflation and low inflation, rising growth and declining growth. And certain types of assets perform well in each type of environment. For example, in inflationary environments like we are having now, TIPS, which are inflation protected bonds, real estate, commodities, and gold are the place to be. In deflationary environments, you want to be in bonds. In periods of high growth, you want to be in stocks and real estate. In periods of declining growth, you want to be in bonds. So each asset has a predictable environment in which it performs the best. The problem is we just don't know when each of these 4 environments is gonna happen and how long each one will last. That's why if you just diversify and have a little bit invested in all of these assets in all of these 4 quadrants, you're gonna be protected no matter what. So if you already have a portfolio, but it's only in stocks, make sure to add something for the inflationary environment, such as tips, commodities, precious metals, and real estate. Not only this, but also make sure you are internationally diversified, because even if the US goes into recession, that doesn't mean Asia, Europe, Latin America, the rest of the world is also going to be in recession. In fact, some of these regions, like in Asia, they'll be thriving even while the US is struggling. So it's very important to not have all of your eggs in one basket. There are many ETFs that you can buy easily to get instant international exposure. There is VWO, which is Vanguard's Emerging Markets ETF, and VEA, which is Vanguard's Developed Markets ETF. So emerging markets includes India, China, Brazil. These are regions that are very not linked to what's going on in the US economy. And then developed markets is Canada, Australia, Japan, a lot of developed countries outside of Europe. The US has definitely had a good run, but its time is coming to an end, but that doesn't mean there's not money to be made in other parts of the world. So if you're already invested or are planning to invest, make sure you are diversified and that you also hold some assets that benefit from inflationary and or recessionary environments. So that is that, but I also think it's a great time to have some extra cash on hand, not invested, in order to take advantage of potential buying opportunities. Although the stock market can go down a lot more from here, there are already some great buying opportunities. In fact, Warren Buffett bought $51 billion worth of stocks already in the first quarter of 2022. And he knows better than anyone else that investing in strong companies with reliable cash flows and pricing power is an amazing way to protect yourself from inflation. Now, I'm no Warren Buffett, but one stock that recently came on my radar is Coinbase. It looks really interesting right now because the PE ratio, which is a metric that shows you how cheap or expensive a stock is relative to its profits, is very low right now. It's at a PE ratio of 6, which especially for a high growth, disruptive tech company is really low. And that's only one of many other potential buying opportunities out there already. So in general, it's a good idea to set aside cash to buy more assets during a crash. That's always a good idea. But you also want to be mindful not to be sitting on too much cash. Personally, I try not to have more than 10% of my overall kind of available money just sitting in cash. Because even though stocks and crypto and assets, even though all these things fluctuate a lot and have a possible loss in value, cash actually has a guaranteed loss in value. The dollar has lost half of its purchasing power in the last 30 years alone, and now with inflation getting this bad, it's losing even more of its purchasing power. 8% in the last year to be exact. So cash is just a terrible storehold of wealth, guaranteed. Which is why if you have a long-term time horizon like me, then the lesser of the two evils is investing in volatile assets that might go down in the short term, but are better storeholds of wealth in the long term. And so I'm a big fan of gold and crypto as sort of an alternative savings account, and I hope you'll look into that as well. Because gold is not inflatable. It's the third major reserve currency in the world. It's been around for thousands of years, and as geopolitical risk rises with like Russia and China, a sovereign currency like gold that's not tied to any country is gonna become more and more valuable. As for cryptocurrency, despite its crazy volatility, it's still fundamentally a better storehold of wealth than fiat currency because Bitcoin is not inflatable either. And so despite the crypto market's recent setbacks, like the Terra USD stablecoin fiasco, I don't know if you've heard about that, but personally, I'm still very optimistic about the future of crypto. In any case, I definitely prefer it to dollars sitting in a bank account. All this to say, don't hold more cash than you need to. Be diversified internationally and across different asset classes. Also, be fully prepared for a possible period of stagflation. And don't be surprised if your stock and crypto portfolio go down even more. And definitely don't panic sell. It's really tough to do, but when it comes to surviving market crashes, the only way out is through, not to jump ship at the bottom and lock in your losses. All right, so that was a short and sweet, quick market update video. I just want to say, you've probably noticed I'm filming in my van right now. So I'm actually in the US, about to start a little van life trip right now. So next week, I'll be posting a van life vlog. I'll be around Los Angeles. I'm going to a music festival as well and gonna check out San Diego. So it's gonna be like a Cali van life vlog. And I've been hinting at this for a while, but I'm just gonna say it. This market update video could be the last finance video that you see from me for a while. Not forever, but just for a while. A lot of stuff is happening in the markets and in the world right now, so I wanted to get this video out because I feel a level of responsibility to you guys. You know, people look to me for guidance when this kind of stuff happens, so I wanted to show up. But really, there's a lot more to life than money and investing and what's going on in the stock market. And there's a lot more to me too that I want to share with you guys as well. There was a season in my life when all I ever wanted was to achieve financial independence, and I could talk about money and personal finance and investing 24/7 without getting bored. And that's the kind of passion that started this channel and brought me this far with you guys. And it's been amazing. But honestly, now that I finally achieved financial independence, it's really interesting what happens. You become less interested in money because it's not an issue anymore. And so now that I'm finally financially independent, I'm interested in other things like van life, traveling with my adorable dog, Jupiter. He's actually right here in case you guys wanted to see him. I also want to talk about being a digital nomad, being a minimalist, and just being 30 something and single, navigating life, relationships, and building a life that I'm proud of. And so if you don't like the direction I'm going in, I totally understand. Feel free to unsubscribe at any point, but I wanted to start giving you guys a heads up that this channel is gonna go in a different direction. I'm making a pivot, I am reinventing myself. And for those of you who plan to stick around, thank you, I love you so much. I promise it'll be good. I'm gonna show you a side of me you've never seen before, and it's gonna be fun. So anyway, as always, thank you so much for watching. I hope you liked this video, and I hope you'll stick around for the next one too. All right, I'll see you guys next week. Same time, same place. Bye.